Hi, my name's Griffin Bridgers. This will be an intro and preview to a broader content series I'm producing called Business Entities for Estate Planners. Largely, this will be a series designed for those wealth transfer professionals who commonly encounter clients holding interests in business entities to develop some of the basic planning acumen you need to effectively navigate planning situations involving business entities. We'll talk about a little more of the limitations and principles of this course in a minute. But before we dive in, I want to remind you, as always, that this presentation is not intended to substitute for legal or tax advice and is being provided for educational purposes only. And on that note, really, with this broader series, the intended audience is going to be professionals who assist with wealth transfers. There's a lot of people in this vein. It could be attorneys, CPAs, trust officers, financial advisors, anybody along those lines. But this isn't a series or piece of content intended for those needing assistance with their personal planning. So if you're in that situation, I would encourage you to contact a qualified professional. I personally am not available to assist you, but with that being said too, this series is really going to be found in videos and articles on my newsletter, griffinbridgers.substack.com, and that's where you can find a lot of the content and articles coming up in this series. But a lot of the content will only be available for paid subscribers to my newsletter. So again, paid subscriptions are intended for the education of wealth transfer professionals and not for individuals needing assistance. So if you are an individual needing assistance, I would encourage you not to purchase a paid subscription to obtain access to the materials, because this is not intended to be a DIY guide. So with that, let's jump into a broader question of why business entities. Now, throughout this video and throughout this whole content series, there's going to be some places where I oversimplify things. So if you have advanced knowledge or even intermediate knowledge in this series, then I would encourage you to just take a step back. Don't worry, there are some intentionally omitted parts that I'm doing so as to be intentional about the way I'm tackling this subject. So please don't reach out or email me if you feel like I've missed anything, because I likely know that I've missed it and it's been missed for a purpose. So just because you teach it a different way doesn't mean you get to reach out and criticize me for teaching it my own way. But let's jump into the broader example. So business entities I'm going to illustrate really as a reaction to what was the common form of business ownership for many years, called the sole proprietorship. So in a sole proprietorship, you typically had one individual who owned all of the business assets in an operating business. But we can't just look at assets, as we're going to find out. We also have to find out and look at business liabilities, which that one individual is also on the hook for. So this dynamic makes it very hard to transfer ownership of that business in part or in full, whether during the life of the sole proprietor or even at death. It also makes it difficult to borrow, take on investors and other things, and spread risk across multiple people. At best, it means tenant and common ownership of business assets, and that change in ownership can sometimes violate covenants for certain business liabilities and contracts, which makes it even more challenging and even more risky to bring in outside owners, not to mention the liability exposure, where a sole proprietorship involves the exposure of all personal assets of that sole proprietor to the business debts and liabilities as well. So, as I mentioned, business entities are largely a reaction to this dynamic, and they serve as a tool to consolidate ownership and management by equity owners. Now, while it's not universal traditionally that a business owner or a business entity is recognized as an individual owner for state law purposes of assets, that is how things have trended, and that can be contrasted with a situation where traditionally, if you had multiple owners, you might have to look at tenants in common ownership of business assets across the board, again, which is not optimal. It's very unwieldy and burdensome to bring in new owners or change ownership percentages, not to mention the question of juggling who is on the hook for business liabilities in that scenario. So with this tool, the business entity, which allows us to consolidate ownership and management, we typically see one of these uses reflected. And again, this is not intended to be an all-inclusive list, but these are the common planning situations where business entities tend to be used. One is pretty obvious. It's conducting an active business for profit. And it could be that the business entity owns the assets that are generating a profit, and some owners may participate in the business, others may sit back and collect that profit, but it's the business entity itself and its purposes that we're concerned with here, one being profit-seeking business, which will be an important distinction, at least at the tax level too, when we compare that with ownership of assets for investment or long-term management purposes as well, which, depending on whether or not those assets are held for investment or personal use, can also vary in terms of the tax outcome. But we can see I've lumped both of those together here in this second purpose, where really we're consolidating ownership of assets, whether it's on a short-term or long-term basis, and whether or not we're holding those for investment returns, a profit-seeking purpose, or simply just for consolidated management long-term, even if a profit-seeking motive isn't there. And then finally, a common purpose, which isn't universal and isn't always guaranteed, as we'll see, is that we can protect the personal assets of owners of a business entity from the liabilities incurred by that business entity in its investment and profit-seeking purposes and operations. And vice versa, possibly that the assets of the business entity itself might be protected from personal liabilities of the business equity owners. So with that being said, a good way to understand this, at least as I visualize this in my mind, is to go back to Accounting 101. The thing you learn on the very first day is that when we consider the balance sheet of any business entity, it's best expressed as assets equal liabilities plus equity. Now, sometimes that's stated as owner's equity, but to simplify it here, really I'm going to illustrate this, especially focusing on the left side of the equation, liabilities plus equity. So our starting point is, let's assume liabilities aren't even in the mix. When a business entity is formed, we have one or more owners who are contributing assets, commonly known as capital, in exchange for some equity interest in that business entity, which is reflected on the other side. So after that exchange, we essentially have assets equal equity. Now, it's not always the case that capital would get contributed or that there's only contributions at the beginning. Sometimes you might have services contributed in lieu of capital. Sometimes capital might be put in the middle, which messes up kind of the ownership percentages depending on classes of ownership. But in either scenario, really that's our general starting point if we ignore liabilities. But where this gets interesting is we have to contrast debt versus equity, because each kind of reflect an interest in an equity itself. And the reason we focus on the left, liabilities plus equity, is because, typically under state law, equity interests are essentially subordinated to the interest of creditors in the business entity. What that generally means is, one, during the life cycle of the business entity, there's no profits to distribute unless or until current liabilities are paid or satisfied. So really, when we look at profits, we look at net profits. So profits distributions are going to be net of, usually current liabilities and business needs, and possibly even a reserve to meet future liabilities and even possibly future business and expansion needs held as a reserve as well. And especially with closely held family businesses, it's often the case that there's never profits distributions, that all the money made by the business gets cranked back into it, depending on the purposes of the business entity itself. We also look at that not just in the life cycle, but also what happens if and when the business entity terminates or goes away. In that situation, we're doing the opposite of what we just did when we put assets in and received equity back. Now we're giving up equity in exchange for assets of the business, which may be the assets of the business in kind, or maybe even the liquidation proceeds if the entity first sells off those business assets, leaving only cash. But for that reverse equation to occur, we have to first wipe out liabilities, again reflecting that dynamic that creditors get paid first. So equity owners only get the remaining business assets if and when the entity is dissolved after liabilities of that business entity are satisfied. Now, within these preferences for distributions of profits or even liquidation proceeds or dissolution proceeds, there can be different classes of equity ownership which might give different priorities or preferences to these distributions of profits or liquidation proceeds. So in this vein, when we look at liquidation, it doesn't necessarily mean that the business entity is being dissolved. Sometimes you might have certain business entities, you especially see this with things like hedge funds or real estate investment or development projects, where perhaps core assets get sold off and there might be liquidation proceeds there. Again, net of liabilities, but classes of ownership might reflect who has priority first to the distribution of those liquidation proceeds. But either way, you need to consider the different classes of equity ownership, where the classes don't override the fact that creditors get paid first, but they might have their own priorities for who receives distributions from the business entity. And it may leave people with lower classes with nothing in a dissolution of a business entity, for example. Now with that, liquidation preferences and distribution preferences aren't the only differences between classes. We might see differences based on rights to manage the business entity itself, or even rights to vote as a normal shareholder in a business might do as well. All of those can be their own distinctions independent of capital. So typically we're going to look at capital rights and voting rights, each of which can have its own nuances when we consider different classes. But that being said, where you have preferences, whether it's for capital or voting or management, there can be trade-offs there too, in the form of the liability of an equity owner for business debts themselves. So again, this is a piece that some people may disagree with in terms of how I've illustrated it here, but since we are on this theme of the accounting equation, I've used this to illustrate what happens if we run into a situation where the business entity's assets are insufficient to meet its liabilities. In this situation, liabilities are greater than assets, so effectively, in this equation, equity has to be negative. So what does this mean? Does this mean that an equity owner is now obligated to pay back to the business entity their share of this negative equity? And for many, but not all forms of equity ownership, the answer is going to be no. For a lot of forms of equity ownership, the owners are going to have limited liability, meaning that the equity owner is not on the hook to pay back their share of negative equity to the business entity itself or to the creditors of that business entity. Now, that limited liability protection is not absolute. As I mentioned, sometimes there's classes of entity ownership that might give greater management or capital rights, but their trade-off may be the loss of some of that limited liability. And I think it's helpful to note that while the negative equity itself may not be owed to the business entity itself directly under state law, creditors know this, and typically that negative equity reflects that creditors are taking on some of that risk as a cost of extending credit. But to reduce that risk, it's pretty common nowadays that creditors of a business entity might go around this ownership structure and contractually obligate equity owners to pay the creditors directly in that negative equity situation if there's a shortfall that business assets are not sufficient to satisfy business liabilities. This could be through a pledge of personal assets of an equity owner or a personal guarantee. So even if there is limited liability, that limited liability can be contractually eroded. And even then, this is a point we'll harp on and really explore in greater detail as we go through this series, where if the ownership and management structure of the business entity itself is not respected or followed, there's certain state obligations under state law that you have to follow, but if you don't follow them, the limited liability protection may be lost through a process called piercing the veil of limited liability. That's an outcome that's usually judicial. It may have some statutory influence depending on the state, but it's something to keep in mind as well. And we can look at liability protection the other way, where sometimes the business entity itself might be concerned about shielding its assets from the personal liabilities of an equity owner. That protection can be lost through a process called reverse veil piercing. We could also see things like fraudulent or voidable transfer laws that affect the exchange of assets for equity up front by an equity owner in a situation where that keeps them from being able to satisfy their personal liabilities on a timely basis. So that's a quick overview. Like I said, very basic. There's still a lot of topics we need to look at coming up in terms of forms of entities, varying forms of limited liability and protection and how that can be lost, differences between tax and state law treatment, and other important considerations, some of which are unique to the estate planning and wealth transfer process, some of which are unique to the life cycle of the business itself, and some of which are kind of independent of those concerns and inherent in any form of business entity. But if you like this content and want to see more on this series, I'd encourage you to subscribe to my newsletter at griffinbridgers.substack.com. You can get free and paid subscriptions. If you don't want to spring for the paid subscription, each of the articles in this series will have a preview, which I think warrants its own reading. So you can stay tuned on that. If you have questions on the material, again, you can reach me at griffin@griffinbridgers.com. But one, I cannot provide tax or legal advice in response to your questions. And two, typically I can only respond to wealth transfer professionals who have questions on the material itself and not specific client situations. With that, I thank you for joining me for this video. I look forward to seeing you further in this content series. And as always, I hope you subscribe and continue to engage with my content. Thank you.